We've come to the lower middle market as a group going back 25 years ago. What we witnessed within the world of direct lending, even a long time ago, was the parts of the marketplace that were the hardest to penetrate and to penetrate at scale had not only a return advantage, but a structural advantage. So you can create a very attractive return profile that was much more durable.
The misconception that there's more risk in the lower middle market is absolutely founded in that smaller is weaker, smaller is riskier. And that's a true statement. The but to that true statement, though, is what is your process? What is your filter of opportunities you're looking at? What are those structural wrappers you can put around these smaller businesses to make them less risky than their larger counterparts?
One of the benefits for us in terms of where we sit is we have a portfolio of over 300 borrowers. So we're able to pick up what are things that are working for these businesses, what are key areas where people have felt stress and how they navigated that. We're able to aggregate that as a portfolio level, work with our private equity firms to make sure, again, real time or on a proactive basis, these trends or issues are being addressed. So I think with the level of uncertainty, right, that is in the environment, whether it be tariffs coming on or off, where inflation or where rates may go, for us, it's understanding the core value prop of these businesses, which means, do they have pricing power? Do they have tools at their disposal based on where they sit within a value chain to navigate these sorts of headwinds?
TPG Twin Brook is responding to these market uncertain times by sticking to our knitting. We haven't had style drift, we haven't had strategy drift. We're a deeply rooted firm in our underwriting process and our portfolio management. We find ourselves in a position where it's stay the course as you approach uncertainty in the marketplace.
Balancing disciplined underwriting with sponsor flexibility is sort of the art of what we do. We have to understand what the sponsor's thesis is in order to be a true partner for them through their hold period. Disciplined structuring essentially drives capital preservation. And the way that we think about that for Twin Brook is having meaningful financial covenants that protect us as performance deteriorates if that were to happen. It gives us the ability to have a conversation with the private equity firm, get additional capital support, reprice the risk. If you don't have financial covenants, then you don't have that, checkpoint before things have kind of gone too far down the path.
There's obviously been a big disruption around AI and software. To our benefit, we really have not invested in those sectors historically. But as we look at new opportunities today, with the disruption around AI and software, it's almost increased the interest in more of the mundane industries like landscaping services, specialty chemicals, HVAC, plumbing, things that we know there's not going to be disruption or disintermediation behind.
Healthcare is going to continue to be a big part of the GDP. It's 18% right now. There's demographic trends that are growing. You have people getting older, people getting sicker. You have a sector that is generally considered non-cyclical, and you have lots of inefficiencies within the healthcare sector, which from an investor's perspective offers up a lot of opportunities to make good investments, buy something, add value, and make a good return.
The last piece I would note specifically to the lower middle market, manager differentiation matters. That value proposition of the lower middle market, that's really tied somewhat to, are you an experienced lower middle market investor? Do you have that history? Do you have that scale? Do you have that consistency? You weave all those things together and you end up with something that's very unique within the world of direct lending and very much in line with what TPG tries to do across all the different asset classes.